Ja, doe nog even voordat het begint hoor.
Hello, hello.
Hello, friends.
How are you doing?
Good. Welcome
Nice.
to the first community call.
Thank you. I have the feeling it's going to be a very small community today, considering all things considered. So yeah, well, but that's fine. I mean, the people are kind of crushed, burning like right now everywhere. So I would be surprised to see a lot of people, but still, I think it's good to kind of have this moment anyway. Hello, hello.
You're Dan.
That's a surprise. That's good.
Most people
starting it for you to make sure it all works.
Okay.
Okay, great. Gonna give it a few more minutes.
Do we still have Jack joining, or?
He's supposed to. I'm pinging him right now.
I'm getting all these price alerts from Blockfolio. Price is up 5%. It's down 5%. Up 5%. Like if you're swing trading.
I also get the same. Are we recording already?
Looks like.
Yeah, I think Dan is recording.
Joining on now. Okay, Jack is joining. Kind of wanted to share my screen. Can you guys see my screen?
Yeah.
Yeah. Cool. I think we can probably edit this video later and just remove the first few minutes. Yeah, I kind of want to start with introductions and yeah.
Yeah, maybe you can send out a tweet or something. Sometimes I see when I'm on Twitter, I see like a last-minute call and I jump in.
Oh yeah, I'm actually gonna do that. Should indeed do that. Hey Jack, welcome.
Hey, what's up, guys? How's it going? Everything good. How about you?
Good. Kind of dealing with the consequences of yesterday. How was that for you?
I mean, it was okay. You know, there's a lot going on in the world right now. So yeah, I mean, you know, I'm happy that it looks like Maker is gonna be able to survive it without an emergency shutdown, and you know, definitely some learnings for everyone.
Yeah, indeed. So I'm quite excited to actually hear your presentation later. All right, so I think we can probably start. So I'm gonna make a small introduction. So my name is Alessio Del Monte. This is the first community call of PieDAO. I'm very happy actually to see you guys here around, considering what happened yesterday. I think that's great. So today is March 13, 16 UTC. I have a small agenda for today. I kind of want to start with a small introduction, just a couple of sentences between all of us. And then I want to go make a few words about the goals of PieDAO we are trying to achieve right now. And then going forward, discussing a little bit how do I think about governance flow and how we can make decisions as a community and going from step to step. And then eventually we're gonna have a short presentation from Jack Clancy at DeFi Score. He's gonna talk us about the methodology that they are using to assess risk and how the rates basically gets calculated to some degree. Then Nick is gonna talk us about the very first file that we are making right now, which is called Cash++. and then we're gonna go more into generic Q&A. Does anybody want to add any point to the agenda, or are we good?
No, I'm good.
Great. All right. So yeah, I'm Alessio Del Monte, as I was mentioning before. I've been involved with development of PieDAO since the very beginning. I've been working on a variety of different DeFi stuff before, including DEX Wallet, DeFi Tracker, DEX Pay, and some other products that you might have heard of. We started PieDAO really with this vision that the future of investing is going to be passive and permissionless. And we really like to think about this new portfolio allocation in a way as on-chain ETF 2.0 that we call DTF. So what PieDAO at its core is really a platform for issuing, governing, and eventually, when the time is right, seeding liquidity into the instruments. We really care about three major points. First one being accessibility for these products. As you might know, some other structured products in traditional finance are sometimes inaccessible because of either capital requirement or geographic restriction, since you need to buy at least a minimum amount. And we think these tools are going to be extremely efficient because in order to deploy a structured instrument through the DAO, we are going to spend, by our estimation, even with a very high price of ETH, around $50. But more importantly to me, and I think to many of you, these are going to be transparent instruments, meaning that we really get the chance to expand governance within the underlying index by reaching consensus through the DAO. Something I like to add regarding the concept of pies is they are designed for composability. And what that means is, being this portfolio allocation being tokenized, we can very easily put them together into broader portfolio allocation. Now, this is particularly interesting, in my opinion, considering what happened in the last couple of months, and also considering what happened yesterday, because as a community in DeFi, we really need to step up our game in terms of having stable source of collateral. Now, a lot of the trouble that we have seen yesterday has been caused because we use as a main source of collateral ETH, which means we are very much exposed to a lot of volatility in the market. So I strongly believe that if a long time, like as we make more and more allocation and by composing them, we might end up in a situation to have a very stable source of collateral on chain. And that might mean for DeFi to be able to lower the collateralization ratio and potentially scale stuff like DAI in the long term. Last thing I'd like to say, since we also seen in traditional finance world, and especially in the last couple of months, stuff like trading desk being outed and brokerage firm being outed, or Robinhood. Welcome to everyone. I see people joining. Happy to see you guys. So since we've been seeing a number of times brokerage firms are up like Robinhood, basically alting, I should have remove that. Alting trading during very heated moment, which is obviously not ideal. I also think it's very important to basically highlight the fact that by bringing structured instruments and particularly exposure to traditional asset in finance, basically every wallet can become an investment platform. Like every wallet gets to be a decentralized Robinhood if they want to. So this was like my really couple of minutes introduction about PieDAO. We're gonna have a more like Q&A question later, but if someone wants to join in, feel free to, obviously. I'm now gonna ask a little bit about how do we think about the governance flow. We have been different people of us welcome newcomers. We have been observing a variety of different governance model across different DAOs, and we came to the realization that the vast majority of governance actually happens off chain, as you might know, and as recent events have been demonstrating. So we really think about on-chain voting as a notarizing effect to some degree. So in that regard, the way we think about governance is basically going deep down into a funnel of discussion. And we have been kind of selecting a few tools that we believe are interesting to use for different stages. So we've been seeing general discussion popping out in the Discord, which are really pretty much kind of brainstorming session in an async way between community members. And then once those discussions are kind of get formalized a little bit more, basically we can formalize that through a post. We are currently using Discourse. So if you didn't just check the forum post just yet, you can go to forum.piedao.org, and then over there you will see some of the discussion that has been going on. I'm actually quite happy about how the forum is shaping up, so keep going, guys. And then eventually when we reach a point where we feel the discussion to be a little bit more structured, I believe it's time to start talking face to face and try to figure out if there are any major concern about the discussion by themselves. If that works out for every one of us and then there are no major concern, I think we can move on more detailed, basically specification for the smart contracts that we want to deploy on chain through the DAO. And assuming we reach consensus through a vote on the specification of the smart contracts, we can actually vote by linking the GitHub issue. I see something popping out here. Yeah, thank you, Nico, for sharing the forum post. That's how do we think about the governance flow. I think we are not trying to impose any specific structure at this moment. We are more trying to basically figure it out how the community is shaping up and then taking it from there. But it looks like this is a decent funnel to follow, and so far has been functional. We're gonna see how that goes in the next iteration for the next PIP. But I think this makes sense overall, and I'd like to hear your opinion if someone wants to take the word.
Yeah, I agree that the formalizing on GitHub, we should wait a bit with that because it's now naturally happening on the forum, which is great because it has a low barrier of entry. But if you're gonna do like very formal specifications of stuff, it should be on GitHub. But for now, it's good.
Yeah, generally speaking, I really think about the GitHub issue as a actual technical specification. So in that regard, if we come out with real specification and actually specs that we need to vote in terms of deploying the smart contract, that is a good place to keep everything together. Okay, great. So I'm gonna jump immediately into leaving the word to Jack. Jack is going to talk us about the work that they've been doing at DeFi Score. I had the chance to meet some of the guys working on DeFi Score before. I think they are doing an excellent work in terms of basically trying to come out with a structured way of thinking about risk in DeFi, especially regarding how do we assess lending protocol at this point. I think that's been most of their work. I will also be interested to know what are their future plans if they're trying to assess new things, including there is platform stuff like synthetics, UMA, and so on and so forth. So Jack, anytime you want, you can take the word.
Sounds good. Thanks, Alessio. Yeah, just give me a second. I'm going to share my screen.
Absolutely. There you go.
You guys see? Okay.
I do.
Awesome. Okay, so Yeah, thanks for having me, guys. Yeah, so the DeFi Score is a project that I and a few others at Consensus have been working on for the past 6 to 9 months now. It came out from us just kind of seeing the general attitudes in DeFi. Everyone was trying to chase the highest rates, and we thought that we could provide a different perspective, because we thought that rates are great, but there's a lot of risk that people might kind of ignore if they're just looking at the rates. So yeah, I mean, I'm sure most of you guys on here are pretty keyed into the DeFi space. So the total value locked is around $1 billion. I'm sure it's actually quite a bit lower now since the big dip in ETH price. But there's been a lot of activity over the last year or two. And as I said before, a lot of users are kind of prioritizing returns over risk. And so we're trying to guide people to kind of the best risk-adjusted returns. So yeah, this is kind of what the DeFi Score kind of breakdown looks like. Just want to highlight that it's open source and community driven. We're kind of the main drivers right now, but we hope in the future that it can become more of a ecosystem wide kind of discussion and driven by more community members outside of Consensus. So yeah, the first kind of thing that we look at is smart contract security, and so that kind of can break down into a lot of different things. Has the code been audited? How many audits have been done? How many engineering weeks went into an audit? Several variables like that. Has the protocol been formally verified, which 2 years ago was extremely rare, but we're seeing it becoming more and more common these days. Bug bounty programs, I think BZX and the last few months have really highlighted the importance of bug bounty programs and getting white hat hackers involved in kind of your security. And then the other thing is smart contract openness. How transparent are your contracts? A lot of different teams have different approaches with this. I think you see people like Compound, all of their contracts are totally verified. You can view the bytecode in Etherscan. Some other protocols, it's a little bit harder to get that kind of information. They might not verify all of their bytecode, so it becomes a little bit harder to kind of as a user to look at the code and see kind of exactly what it's doing. And so then the second kind of factor we look at is financial risk. And the two kind of aspects that we look at in financial risk are like the collateral risk and the liquidity risk. And so for the collateral risk, we're looking at collateralization and utilization ratios, and the CVAR, which is conditional value at risk, which is basically kind of a financial model that tries to take into account like long tail black swan risks to see kind of what is the maximum amount a certain type of collateral could fall based on historical data. And so the liquidity is another factor here. We're looking at the absolute levels of liquidity right now, as opposed to utilization, just because, the larger amount of liquidity in the protocol also kind of has this added side effect of it being kind of like a bigger bounty for someone that wanted to hack it. So we kind of operate under the assumption that protocols with a lot of liquidity that haven't been hacked for a while are probably safer than something that's a little bit untested, a little bit more untested with less liquidity. And then the third kind of factor we're looking at right now is protocol administration, which is kind of admin keys, how do upgrades happen, all of that kind of stuff. And I think we're seeing other people kind of doing some really interesting work here, like Chris Bleck with DeFi Watch, And I think that this is something that we're actually going to be focusing on more and more going into the future. And then the last kind of aspect, the second aspect of centralization risk is oracle risk, which is another thing that we're definitely trying to do more with. You know, this kind of centralization risk factor was the latest addition to the DeFi score, or the latest kind of factor that we started looking at. And we're hoping to kind of iterate on that in the near future. And so, yeah, just like a plug of Compare, which is another product that my team built that kind of tries to give users a more holistic view of the lending markets and allow them to evaluate their options a little bit more clearly. You can check that out at defiscore.io. And then we also have an API, which is kind of exactly for this kind of thing, for, you know, other projects that are, you know, trying to build structured products or something else, build wallets that allow users to better evaluate the risk. This is, you know, basically allowing other people to kind of plug in to our data. And this is completely free, and we have no plans of charging for this anytime soon. So, you know, if anybody is interested, you know, feel free to reach out to me on Twitter or Telegram or Discord to chat about this. So what's next? In response to some of the BZX hacks, we actually have a proposed change on the smart contract audit side to be a little bit more structured on how we kind of judge smart contract audits. And that's including engineering weeks, when was the last time it was audited, how much has the code changed since it was last audited. And so that's kind of still up for discussion. If you go to the DeFi Score GitHub, you know, feel free to make comments if you have any additional thoughts. And then, yeah, on top of this, we're planning on launching DeFi scores for market making pools like Uniswap, Curve, Bancor, and I'm sure there'll be many others in the future. And then, yeah, eventually we'd also like to provide DeFi scores for staking, and also for like structured products like PieDAO, DeFi's app. So yeah, I think, you know, our goal is to try and provide guidance on risk assessment for as many products as possible. And, you know, I just want to say that, you know, this is still early stage work. You know, I think as the last few months have shown, there's still a long way to go to maturity for a lot of this stuff. And you know, DeFi Score is the same. It's not meant to be kind of the end all be all of risk and that discussion. It's really more of a starting point. Yeah, I think that's about it. If you guys have any questions, you know, feel free to ask me now, or you know, hit me up on Twitter, Discord, Telegram. Happy to answer anytime.
Thank you very much, Jack. Great presentation. I actually do have a couple of questions, but first I'd like to say that generally speaking, I do love the mission of providing guidance in terms of risk. I think that's great. I also really appreciate the idea of basically including into the methodology economical audits or financial audits for that regard. And I'm gonna actually start my question from that side. I'd like, you know, if you can elaborate, or if you do have an opinion about some of the platform that we have been seeing coming to market, stuff like Gauntlet Network, for instance, which basically enables smart contract to dynamically get some value of risk and potentially pay the entire network for pretty much risk statistics and stuff like, okay, how much that type of collateral is at risk of collapsing for some reason, or what is the surface of, you know, attack through flash loans, all these kind of things. So the question being, how do you think about this automated solution, and do you think there are tools which are more mature than others? Where should we look at?
Yeah, no, that's a great question. Yeah, no, I think Gauntlet is doing like really amazing work. Tarun, one of the founders of Gauntlet, is like an off the charts smart guy. basically what they're doing is what's called like agent-based modeling, right? Where, you know, they have a bunch of kind of actors, programmatic actors with a certain set of behaviors that they're trying to optimize for. And then they're able to kind of play with those assumptions and see kind of stress test the protocol based on some of these assumptions. And, you know, Compound was, I think, the first kind of large scale DeFi protocol that got an audit from Gauntlet. I can share it in the chat in a few minutes. It's a really interesting read. Yeah, and I think, you know, that is definitely kind of the future of some of this stuff, right? Like being able to kind of test the giant range of possibilities for all of this stuff and seeing kind of how the protocol performs given all of these different kind of variables is really the future. And I'm hoping that, you know, we can work more with kind of agent-based modeling in the future as a DeFi sport team, whether that's with Gauntlet or kind of on our own. And I would say that, yeah, Gauntlet is probably the most advanced solution for that. There's like a couple of Python libraries out there that are built for doing agent-based modeling. But I think what really separates Gauntlet is they have built their own kind of version of the EVM that they can actually like run all of these tests inside of the EVM, which I think, you know, just provides that extra bit more kind of like realisticness of their modeling.
Yeah, I totally agree with that. So I want to see if someone else has some questions. Otherwise, I have a couple of more that I'd like to share. So I'm going to give it a couple of seconds.
Yeah, I have a question. Is like when combining like more DeFi protocols. So like, for example, if we do a portfolio allocation that includes more than one DeFi protocol, like the score will be like we should consider average of the selected protocols, or like there is some more complex methodology to extract a combined score?
Yeah, that's a great question, Nicola. And it's definitely something we've been thinking about as well. I think, you know, right now the kind of main approach that people have been using that I think makes sense is using a weighted average. But I think that, you know, for it to be a little bit more robust, it's going to have to be, you know, something more than that. I can't, you know, give you a full answer right now because it's something that we're trying to work out ourselves. But I think for right now, yeah, like without a kind of more robust solution, that a weighted average makes the most sense.
Good. Thank you.
So you have been touching briefly about a couple of concepts which I'm very interested. One being, you know, this kind of to some degree Lindy effect, where we tend to consider protocols that have for a very long time a big amount of liquidity as safer to some degree because they are kind of bigger bounties for people to hack. I've been arguing with some of my friends, and some of these are in this call before, that while that is true, there is probably some kind of threshold for that to actually happen. So I would argue that you know, to some extent, a protocol which doesn't even cross like 500 million in USD value. Let's say like the Lindy effect that starts from there. I kind of want to know if you have some opinion about that, or if you guys consider time from day zero, meaning zero liquidity.
And when you say time from day zero, like what exactly do you mean?
I mean, because I think I saw like within the slide that part of the methodology is considering how much time the protocol has been up and running on mainnet with liquidity in it. And we tend to consider those to be more secure, generally speaking. And I'm wondering if you guys think about some minimum threshold of capital within those protocol for this effect to actually start. So, because I would argue, like, if a protocol is been up and running with only a couple of millions for 1 year, then that doesn't really matter. What it matters is it's been up and running for 1 year after 500 million or something like that.
Yeah, no, I see what you're saying. Like, you know, if it was, for example, like a protocol was a year at, you know, $10,000 and then suddenly jumps up to, you know, 5 million, that's very different than, you know, a protocol having 5 million the entire time.
Yeah.
Yeah, no, go ahead, Alessio,
Yeah, no,
sorry.
No, sorry. You exactly got it right. And I'm trying to, because I've been debating this argument for a while. It's very difficult to come out with a number that everybody feels comfortable with. So I kind of want to see if you guys had some thoughts about it.
Yeah, so I think the way we were thinking about it was like, instead of like looking at the kind of max liquidity value, kind of like comparing the protocols relatively based on the sum of like, liquidity over days kind of a thing. So, like a protocol that had, 5 million for a year is probably, that hasn't been hacked, is probably safer than a protocol that's had 1 million for a year. So I don't think we're trying to set like a minimum value, but I think that it's somewhat captured in the fact that, we are going to be comparing them relatively based on kind of like the sum of liquidity over days.
Mm-hmm. Yeah, that makes sense. And obviously all these kind of consideration are extremely helpful for us, because what Mick is going to present in a little while is our first allocation, which is called Cash++, which aims to basically give weighted exposure through a variety of different lending protocols, which have been assessed by DeFi Score. So I was very excited to hear your opinion. Before moving the mic to Mick, I'd like to make one last question, which is a little bit related to the most recent event happening yesterday in MakerDAO. Like, I think during the presentation, you've been touching slightly about oracles and how easy it is to manipulate those oracles. We've been seeing a lot of attack vectors happening through either on-chain oracles or some kind of manipulation of prices. Now, as long as I'm aware, I might be wrong. Right now, oracles on MakerDAO are undisclosed. We don't know, where the people running it. So it might very well be that, a single centralized party is running all of them. Does DeFi Score has been thinking about that in terms of MakerDAO? Does he have an opinion, or do you have an opinion, personally speaking?
Yeah, no, that's another really good question. Yeah, so I mean, at least kind of like what the MakerDAO team says is that it's like a distributed kind of network of price providers. There's no way for us to verify that. They're very tight-lipped about who kind of the price providers are. I think that they've quoted numbers like, like 11 or 17 kind of different entities providing prices. And that's actually one of the things that we kind of look at in the Oracle score. Is like, is it a fully decentralized network of providers like Chainlink or something, or is it kind of like a distributed set, or is it a single provider? And I think until yesterday, a lot of people kind of looked at kind of the centralized providers as being very centralized, but one of the more secure kind of implementations, because, as we saw with kind of getting on-chain Oracle prices with BZX, is that, they're prone to manipulation, and it's hard to kind of reason about all of the different possible kind of manipulation attacks that can happen with on-chain Oracle prices. But I think, yeah, like yesterday showed us that, even centralized networks, are prone to a different set of problems, like, gas prices going through the roof, and, providers not being able to get their prices on chain quickly enough. So yeah, I think, as I said earlier, oracles are definitely something we're going to be looking at more. I think it's a good starting point, what we have so far, but I think that there's definitely improvement that needs to happen there.
Yeah, thank you very much for your answer. And, as long as the methodology improves in a variety of different aspects, feel free to reach out to us. We would love to have you again and, kind of share whatever are the updates that DeFi Score is working on. So thank you very much again for your contribution. I'm now going to leave the mic to Mick the Graph, who has been, for the very first time, instantiating the first proposal called Cash++. He's going to talk a little bit about that. So go, Mick. Thank you very much.
All right, can you see my screen now? Yeah, right?
Yeah.
Cool. So Mick the Graph. Smart contract development with PieDAO, which is great. And let me check. So we've been working on this thing. It's called Cash++, and it's a diversified portfolio of interest-bearing stablecoins to mitigate risk of the underlying of one of the underlying assets failing. So as you can see, we have a basic allocation right here with some CDAI, CUSDC, ADAI, AUSDT, AUSDC, and CHAI to spread the risk. This is great. Yeah. So why do we need this? If you can see, we had recently had BZX kind of fail. They did not lose any pack, or there was no money lost in DAI, but the liquidity was suffering. The maker-keeper system malfunction, which could destabilize the pack of DAI. There's always possibility of regulatory crackdowns. If you look at centrally issued stablecoins, they can take down Circle or the company bank Tether. You have the admin key risk of the underlying protocols such as Compound or Aave or any other one, and of course the smart contract risks. And also, why would you hold a stablecoin in the first place? Well, we've seen the markets collapsing, so there's obviously a need for a stablecoin in some situations. This is the nice AEX, which is the index of the Dutch stock exchange, which has been collapsing. So fiat is seen as a safe haven at the moment, but the current stablecoin solutions in crypto are not that safe at all. So how do we do this? We create a passively managed index of multiple interest-bearing stable assets, which is a managed balancer pool. You can see how it works at balancer.finance. And it's pausable, so if at any point something goes wrong, we can press the pause button. And it's upgradable, which means we can update the underlying codes if we want to add functionality or there's an issue. So the design principles are the following. We want to keep it simple, upgradable, and versatile. We have a lot of ideas of cool features which can be in Cash++, but we should not have now because there are a lot of work and a lot of risk analysis needs to be done to actually do it. And versatile in the sense that we can upgrade it and add the features. So this is the basic idea of the smart contracts. We have the, my mouse is horrible. We have a proxy contract which wraps around it. It does delegates call to the smart pool manager, which communicates with the underlying balancer pool. So we create this balancer pool with the underlying assets in there. And then if you want to add or remove liquidity, you go to the basic pool and to the controller, to the manager, and this adds liquidity to the balancer pool or activates trading on the underlying pool. So what happens if you want to rebalance? Because we have the weights set at the beginning, but they might start shifting, or one of the underlying protocols is not the risk analysis was not correct. Well, we upgrade the smart pool implementation, so we can set new weights, and we slowly ease the weights in the balancer pool, at which point we enable the trading on the underlying pool, so it rebalances in quite a similar way as the Uniswap pool rebalance. And once it's rebalanced again, we close the trading because we cannot have trading open all the time, because if one of the underlying assets fails, then it will get dumped into the market and we are overexposed. Does that make sense? Okay, and what are possible features we want to have? We want to have continuous rebalancing by enabling the trading on the balancer pool, which creates additional yield for the holders because they are liquidity providing. We want to have circuit breakers much like stock exchanges, where if one of the if the stable asset gets dumped, it stops accepting the stable asset. We don't want an adaptive curve to better suit stable coins if you want to activate a continuous rebalancing, much like curve finance. And we want to change the weights based on DeFi score at one point. So then and maybe we can show you how it actually works at the moment, at least adding liquidity to it. I think I closed it. So we have deployed on Coven at the moment. You can
to MetaMask. And we can then join the pool. So now we can mint, for instance, 1 unit of Cash++, which pops up the MetaMask thing. We wait for the transaction to confirm. At this point, you can see it takes all the underlying stable assets and wraps them into the Cash++ portfolio and gives you back the 1 Cash++ token. And we can also go the other way around. It's relatively self-explanatory. So that's it for me. Yeah.
Thank you very much, Mick. I think this is great. I'm very excited to see this working. And I think more generally speaking, something that we want really to achieve in terms of this allocation are, well, some side effects, right? Because as Mick has been mentioning multiple times, like by having this kind of weighted allocation, what is going to happen is, even if it's a protocol is getting hacked, then 66% of your position is going to be safe. Everybody has been worried for a very long time that USDT might not have any reserve left or is actually under collateralized. So if that was the case, the weighting on USDT is pretty small right now because it's only being lended out on Aave, which means even if USDT goes to 0, 93% of your position is safe. And then if something like USDC actually starts censoring, which I think we might have heard something like that, some ideas about that regarding potentially censoring stuff like Uniswap. In that case, 64% of your position will be safe. I also think it's very interesting to think about that in terms of getting a broad exposure to diversified interest rate without the need necessarily to arbitrage or to basically rebalance from one lending protocol to another. I recall that I saw some of the lending aggregators during the spike of rates in BZX, basically rebalancing their entire position to BZX because it was algorithmically managed. And that's not great, obviously. And that's also why this is a case for really having a social contract governance layer on top of these kind of tools, which are as much decentralized as possible through DAO governance since day 0. So no admin keys involved or anything like that. I kind of want to open up the discussion if someone has some comments about this. Generally speaking, part of the weighted allocation is based, as we mentioned before, on the DeFi score assessment. I was also extremely fascinated to potential development for this allocation, or maybe like a compounding allocation, for instance, for insurance, with shorts on DAI or something like that. That's something that we are probably going to discuss eventually at some point in one of the future community call. But does anybody have any specific question about Cash++? By the way, I'm going to link over here the discussion happening in the forum for async conversation. So if something comes out later, please feel free to vocalize it. Okay, I feel like there are probably not many questions, and I'm going to make one for Mick. We've been touching today on the subject of making sure that smart contracts are audited. And I think something that we've been doing, which is great right now, is to rely on smart contracts which have been audited multiple times. And this is the case for Balancer. So how do you feel in that regard about the auditing which has been done for Balancer? Like, what is the confidence rate that we put on those specific auditing? And do we need anything more to feel a little bit more safer?
I feel relatively comfortable with using Balancer for the Cash++ portfolio, because the most complex thing about Balance is actually the rebalancing math. which we will not be using in the beginning because we turn the trading off. And other than that, it's just adding and removing liquidity, and there's no complex code involved there. I actually feel more comfortable with using that than instead of using set, for example, because set is quite a complex thing with quite a large surface. So for Cash++ at this moment, I feel comfortable with Balancer, yeah.
Got you. That's great. By the way, I also wanted to share real quick this Excel. I'm gonna share it in the chat. You guys feel free to fork it or play with it. I've been updating the current rates based on DeFi score. So like at the point of talking right now, basically you will get a diversified exposure within a variety of different protocols, which accounts for around 17.16%. And you can kind of play around in seeing, how your position will look like with a smaller investment or a bigger investment. As you might notice, the weighting between the protocols is nearly equal, leaning a little bit more through Oasis, considering VHI, considering that Oasis to some degree is really not a lending protocol, even if it gives yield, and it's way simpler compared to basically any other lending platform out there. So I'm gonna link this here into the chat. If someone has, you can also find this Excel file into the forum post. If someone has some major concern about the specific allocation, please feel free to vocalize it. Otherwise, we are going to formalize it through a GitHub issue, and this might be one of the next proposed vote for PieDAO. I think Mick is also happy to share the address for the the GitHub repo and also the address for the code on deployment. You guys should, feel free to break it as much as you can, or yeah. But thank you very much, Mick, for showing this off. I'm very excited to see that, and I also know that we are putting some efforts in building UI to facilitate the use, which is based on our previous UI of the testnet for AWT++. So at this point, we are right on time for the last 10 minutes of Q&A. So if someone wants to jump in and kind of, I'd like to open the discussion at this point. And I also got, take the time to thank you very much, all of you, to have been joining this call. I was very excited to see some people popping out. I know it's been a very rough week, and especially a very rough day yesterday, and everybody's still kind of dealing with the situation. Does anybody want to say hi?
Actually, I'd love to jump on the question.
Yeah, do that. Jump on the question.
Okay, awesome. Yeah, I have a question, actually tying back to the presentation at DeFi Score. I'm curious to see whether maybe you guys have been finding any sort of correlation between yields, let's say returns, and the DeFi Score that you've been putting together. And just maybe, if any sort of correlation has been run, what were the findings, since we've been kind of used to often being exposed to this kind of risk return trade-off from let's say the old financial ecosystem. But I'm actually curious to see what are like the possible correlation of this, DeFi Score impersonating protocol risk and return.
Yeah, no, that's a great question. Yeah, no, I think that we've definitely seen, I mean, I haven't run any like statistical tests for correlation, but, just based on my intuition, we've definitely seen kind of a negative correlation between DeFi Score and the yields, which generally makes sense, right? As things get more risky, people are expecting, higher rates of return. And I think we saw that yesterday with DAI rates spiking on pretty much every single platform. And I think they're still up really high right now to kind of reflect the new kind of risk environment that we're in. I think we also saw that with the BZX hacks. You know, BZX ETH, or sorry, DAI was at, you know, 30% for, you know, a sustained period of something like a week. And ETH was at 42, 44%. So yeah, I think, you know, there's no free lunches in finance, which is, you know, a very famous saying. And, you know, I think we're seeing that be reflected in DeFi, right? As things get more risky, people want a higher rate to you know, risk their capital.
Great, thank you.
Yeah, absolutely. Like, I actually do like the quote of the only free lunch in finance is diversification, because to some degree, that's what we're trying to achieve over here to a more professional level. That being said, is anybody else has a question for Jack or Mick? Otherwise, I would like to ask Jack if he has any specific comment about the allocation of Cashpal Plus. I know you have been looking at it before through the forum, which I kind of invite all you to join. Yeah. So, do you have any specific suggestion, like how do you look at the Cashpal Plus allocation, or do you have any thoughts?
Yeah, sure. I'd love to jump into that, but I actually have a quick question for you first, Alessio.
Absolutely.
How do you guys kind of think about distributing kind of governance shares, governance votes right now for PieDAO?
Yeah. So I actually was planning to talk a little bit more about governance. We are basically playing around with a slightly different model of governance that we've been seeing before. So, like, our end goal is to basically come out with some sort of financial committee. So we've been seeing like that in some DAOs, the vast majority of the people that actually make the work are mostly a handful of people, and that's you know, that seems to be true for decentralized organization in general. So the way we are thinking about long-term governance is we're basically going to make a elected financial committee where people can basically propose themselves as a financial governor, and then people can delegate into the basket of the specific governor that they feel be more comfortable. They might need to provide credentials. We want these people to have long-term vision on the kind of work that we're going to do, and we want these people to have skin in the game in terms of actually putting the work on a daily basis, in terms of you know, rebalancing the portfolio or making the right assessment for whichever asset we are working on. And for that reason, we're also implementing a staking mechanism. So assuming you actually get elected, you will be required to basically stake for at least 1 year. And then for that reason, you will get staking rewards. But that also means that if you are free riding in the system, or if some of the other people in the DAO feels you have been malicious or you are misconducting, you're going to be heavily slashed in that regard. As for now, the vast majority of the people which are joining the DAO are reaching out to us personally. So we still have the luxury to kind of vet them to some degree, which is a very good way to start or initiate a first selection. But as things scale, we might need to open up the governance into a more of election of an elected system.
Got it. Yeah, thanks for that. That sounds very interesting. Yeah, now I can answer your question now. Yeah, no, I think that the initial kind of cash plus allocation looks generally good to me. You know, I think as I kind of said in the forum post for anyone that didn't catch my comments, you know, I think that there's a lot of correlation in DeFi right now. So, you know, I don't think we need to go too crazy with trying to add like every flavor of stablecoin that's out there. Just because, you know, I don't think it's going to add that much diversification benefits. And the other kind of big comment that I made is that just be careful with your kind of exposure to chai, because, you know, as I said in the forum post, you know, Compound DAI kind of uses chai under the hood for all kind of liquidity that isn't borrowed out. So, you know, the actual allocation to chai ends up being greater than kind of the 35% that you guys are currently planning to allocate. So yeah, I would say that those are kind of the two main comments that I have.
Yeah, I think that's a great point, and that's something that we definitely gonna think a little bit more about. I also do believe it's interesting to go on a more, well, basically pretty much on a iterative approach in that regard, and that's part of what the governance game can bring to the table in terms of iterating on a different variety of allocations overall on a quickly basis. Yeah, thanks for your comment. I really appreciated like your points made in the forum.
Of course,
Also,
my pleasure.
Regarding the DeFi squares, is there how much of the data is available on chain? Because like some of the some people are building like rebalancers based on DeFi score, but is this data like, can I get like calculated DeFi score of a protocol on in a smart contract? Is that possible? Or?
Yeah, that's actually something I should have mentioned this earlier. That's something that we're working on right now. We're working with Chainlink right now to get DeFi scores on chain. I think we're expecting to have it on testnet in the next few weeks. And we're hoping to get that on mainnet as soon as possible. I think a lot of the like rebalancing protocols are moving some of their logic off chain. So I think some of them might be using kind of the regular kind of HTTP API for doing some of the rebalancing, but we also obviously want to provide scores on chain because there's lots of use cases that enables. So basically coming soon.
Yeah, and how quick is DeFi score to respond? For instance, when the Fulcrum thing happened, did the DeFi score drop very fast, or did it take some time after the hack before it responded?
Yeah, so the way we're calculating it right now is that we were calculating it was that it was updating every 4 hours. And after the BZX hacks, we decided that like wasn't fast enough. So like once everything happened, the score did respond. But just because of the way that like we're programmatically calculating the scores every 4 hours, it took 4 or 8 hours for kind of the market to, or for us to react. And so we're actually like working right now to bring that down to, I think to like a minute to minute basis, or at least like every 10 minutes. So we're expecting it to become much more responsive in the future.
Oh, that's cool.
That's great. Like, are there any plans to actually do some kind of risk assessment about stuff like Balancer or Uniswap or CureFi or anything like that? Is that something in the roadmap or?
Yeah, definitely. We actually we were planning on releasing like Uniswap in sometime this month. We actually switched priorities. We're going to be launching soon kind of like a less quantitative, more qualitative dashboard, kind of similar to DeFi Watch, but with like a lot more data. And also kind of like the on-chain governance events for all of the protocols that we currently support. So that should be coming out sometime this month. And I'd expect kind of Uniswap to follow closely after that. And when I say Uniswap, I mean Uniswap, Bancor, Curve, and Balancer, just all the AMMs.
Yeah, that's great. We're gonna love to read those reports and kind of to some degree consider that in our own stack. All right, guys, we are about an hour into this call, so we were planning to cut it around now. I still want to give a little bit of time to people to jump in if they want to. So this is the right time. Otherwise, I want to thank again Jack for his participation, and I'd like to invite you all to start testing the Casper Plus allocation on the Kovan network. Mick is going to update shortly the forum post with the GitHub code and also the Kovan deployment. You can use it through Etherscan. You can basically test it by yourself and then come back to us with any major concern you might have.
Jack, it's Peter. I have a quick question for you. You just mentioned Chai. It's kind of interesting that there was no issues yesterday while DAI was actually going the other way, because you said there's more risk to the Chai owning it on underlying issues than DAI. Do you see any issues with that, or any problem that why wasn't following the DAI, how the DAI was rallying up like that?
I'm not sure I understand your question, Peter. Could you clarify?
Yeah, so you were saying that chai is a little bit more riskier than DAI. Is that what you said earlier?
No. Sorry if that was unclear. I was just saying that compound, like the compound DAI markets, actually lock up all of your unused DAI in chai. I would still say that, you know, like compound DAI, CDAI, for example, is probably more risky than chai because compound is using chai under the hood. And on top of that, you also have the counterparty risk and all of the other kind of associated risks with compound, like borrowers defaulting, you know, compound has a bug, stop working. So I'd say, you know, chai is probably, apart from DAI like itself, is probably like the least risky kind of way to earn yield on your DAI.
Yeah. Okay. Thanks for clearing that up. And when I saw Jordan in London in the hackathon and in Paris also. And one of the things I mentioned to him when you guys do these DeFi scores, if you guys can score the teams, right? So, you know, there's a lot of these DeFi teams are very good what they're doing, but it seems to me there are a lot of developers and programmers, and some of them don't understand the economic part of it and how the actual financial part works. So do you guys have a chance to maybe look at all the teams that, you know, involved in on these DeFi teams?
Yeah, I mean, I think it's really hard to like objectively like assess people, right? I mean, it's already like hard to objectively assess like these different protocols, but I think like assessing people is like even more difficult. But I think that, you know, kind of one of the things that we're like, one of the ways that we're addressing, you know, just because you're like a computer programmer doesn't mean that you understand financial markets and all of the risks associated with that. So I think that that's kind of why we're introducing like the requirement for an economic audit or a financial audit, because I think, you know, even if you don't understand the financial side of it super well, like, you know, you should outsource some of that to people that do. And, you know, as Alessio was saying earlier, you know, I think Gauntlet and, you know, there's other people out there, even kind of Zeppelin has started taking a little bit more of a look on the kind of economic financial side of when they're doing protocol audits. And I expect that trend to definitely increase, especially, you know, after yesterday. It wasn't really a code failure. It was kind of like an economic incentive failure.
Yeah, remember, I mean, just, you know, you couldn't even get it in and out of the trade because the gases were so high. And I think that was for probably the rest of the guys like, you know, like C++, the Cash++ or the Balance. How would their, you know, everything would have been going well for you guys? If even looking at how the market was moving, you think your protocols would be worked out well? You guys don't have any issues because almost most of half of the protocols have issues.
Yeah, I think to some degree, like we are not going to enable the trading within the entire pool, so like that shouldn't really affect us that much. Obviously, like if one of the underlying assets will go to zero, that's where governance need to intervene in terms of switching the weights like as fast as possible, and that's to some degree the importance of having a social layer on top of this protocol to basically potentially react in the quickest time available to these kind of things. Yeah, Mick, do you want to add something? I feel like I stopped you.
Yeah, I think for the stable asset, it's not really an issue. If DAI was having a hard time, it could have lost its spec, but then only a part of the portfolio would lose its spec, so it would spread out the risk. So I don't think, and even for like portfolios like AWP++, the risk would not be as much in our own protocol, but maybe in the underlying synthetic assets in situations like this.
Yeah.
But not so much on our side. But it's definitely something to consider when including certain assets. And that's why we're also, for instance, we're also thinking about doing the same we're doing with Cash++, but doing it with synthetic Bitcoin variants or bridge Bitcoin variants, so TBTC, RenBTC, IMBTC, and SBTC or whatever it is. So like, if you can like then own Bitcoin, which is spread out across multiple protocols, so if one of the protocols fails, you still have some part of your value. So I think our system would not suffer from this, but it would actually provide you with a way to hedge your risk against situations like this. Yeah.
Okay, and I'm sorry I missed the early part of the call because I was away. But you were talking about oracles. You guys, what are you guys? Are you guys using the same oracle, or everybody using Chainlink again, or you guys have a different one?
We don't really have to use Oracle in that degree, right? Because we are mostly doing like weighting stuff within the allocation. So assuming we might need to rebalance the pool, we just need to enable trading for a small amount of time within the pool, and that will happen within the actual price, which happens through balancer pools, since they are completely interoperable between each other. So in that regard, the price basically follows. It's more similar to the way Uniswap works to some degree than anything else.
Sorry, I missed earlier. Maybe it was a silly question. So sorry about that.
No, there are no silly questions. Like in that regard, someone else, we were mentioning oracles regarding some of the issues that we've been seeing yesterday into the broader DeFi environment. And yeah, no, but that was a good question. In our, like, I actually think to agree upon it in terms of also diversifying the underlying risk of smart contracts, which we are going to use. So I'm extremely fascinated by the idea of basically building a pie which is based on balancer, and potentially building a new pie which is based on Melonport, and a new one which is based on something else. I think that's a great way to not put all the eggs in a basket, because PieDAO is really thinking in a granular term in terms of portfolio location. So assuming there is a major smart contract bug in one of these underlying protocol, then they shouldn't crash altogether.
I mean, can I ask a question real quick? And I apologize that I came in really late. Being
Hey, Adam, how are you doing?
The last several
Happy
days,
to see you.
I have a backlog of client calls. People are a little freaking out. Anyway, so I apologize.
I can imagine that.
So as far as decentralization goes, trying to use Melonport and Balancer and everything else, if, you know, as you said, some of the smart contracts don't work or something, how susceptible are the funds at that point? What happens? So if I invest, you know, $10,000 in a fund that's released, you know, through PieDAO, and you're using Melonport, and Melon goes away, like the smart contract doesn't work, are my funds at risk? Or is Melonport just the governance of it, and if that doesn't work, we can just take everything we've done and move it to another asset management protocol?
I think that really depends on the kind of attack that we are looking at. Like, it's very unclear. Like, this is, I understand the concern, because I think we all need to face the risk in that regard. But yeah, like it's very unclear, like what would be that kind of attack. But assuming Melonport is vanishing completely, or like all the funds are stolen from all the underlying contracts, then yeah, the risk is there. Like, we might look at very specific things like insurance, even though some markets, including Nexus Mutual, are still pretty small in terms of liquidity wise. So insurance is an option. Yeah, but like it really depends on the attack. Like, assuming an hacker will basically steal the entirety of the underlying assets. If there is no insurance, it's very unclear how can, you know, those can be recovered.
Okay, so we'll have ideally, if we can, get some sort of coverage on the actual smart contract, and then I assume there, you know, depending on the proposed allocation, there might be some hedging in there using, you know, some of the options strategies that are out there or something, correct?
Yeah, that is correct. Like, so one of the things, like, to go back to the example of the Cash Plus Plus that we've been thinking a little bit about, might be to basically bind a new allocation, which is like Cash Plus Plus I, which stands for insurance, which basically bounds a bunch of tokens with it. That might be useful to mitigate the risk of the entire allocation.
Okay.
So insurance is definitely an option, and that's something that yeah, we are discussing. And actually, if you do have specific opinions or suggestions, I would definitely encourage you to vocalize those into the forum. There are a number of different stuff which is coming out. A new project which is also very interesting. I don't know if you guys heard of. I think it's called Unleashed. So they are looking at new insurance structure. Like, it's a little bit under the radar, so I don't have that many details. But I've been in touch with the founders, and yeah, I'll be happy to share more about a variety of different options that we have insurance-wise once I have a clear understanding about the options.
Got it. Okay. Thank you.
Thanks, Jack. I see you're
Jack.
dropping by, I think. So thank you very much for joining us. And we'll be in touch soon.
Later, guys. Thank you.
Bye. Ciao.
Thank you,
All
guys.
right, guys. I think we're going to wrap it up for today. All the information which has been shared so far will be available through the forum post. I think yeah, someone is going to post like a small summary of what has been discussed, if there are any major points that we should further discuss. We are planning to have the next call next week on Friday. The time might slightly change. We are trying to make sure that everybody can join, but obviously as a global community, yeah, we need to pick PieDAO. So there will be a new forum post with a new proposed agenda for the next week call, and then keep up the good work, keep up pushing the community to vocalize their opinions, and I am extremely confident that together we're going to come out with incredible stuff. Thank you very much, everyone. Feel free to hang out a little bit more, but I'm going to stop the call now. Ciao.
All right. Thanks, everyone. Stay safe.
Thanks. Stay safe. Bye.
Bye.
Bye. Bye, everybody.
Bye. Ciao. Ciao.